like we cannot be thinking of quarterly earning per share and those kind of things. Like it will not justify, or it will never justify the investment in R&D and automation. So, if we have a very myopic view, a short-term view, then it will never, a company would never be able to grow, and become globally competitive, at least in our space. In consumer durable space, like you need CapEx. We are talking of, CapEx-light companies, and that was the, like term we stood, like for ages. And now, like everyone is preferring manufacturing companies, who have invested in technology, in expansion, in capacity creation. So it is giving benefits. It is giving benefits. Like, it happened with us about a year back when we tied up with Hisense, which is a global #2 television company right now, and top 3 consumer durable companies in the world, in China. So they were not present in the Indian market. And like when we deliberated amongst ourselves, we found that this investment, yes, it is considerable investment for us, for the company. Maybe, like we'll have to take some long-term debt to support that investment. But, that company which has a revenue of close to $37 to $40 billion in consumer durables, who have missed the bus somehow in the Indian market, but has the capability to, like give us the technological learnings to, like help us in building systems, to help us create a company which can actually, say, let us take the example of Haier Electronics. They built the company brick by brick in the last 10, 12 years. And today they have a considerable market, market presence and market share. Similarly, like this investment for us, we are very confident that, like this investment over the period of next 2-3 years, this brand is going to support our overall capabilities, is going to support the overall market valuations, market cap of our company. So these are the kind of, decisions which entrepreneur has to take. He cannot be, he cannot be limited by the fact that what is the impact of the next quarter, on the EPS. If we look at the quarterly results, then we would never be able to take long-term bet.
And Sunil, same question for you. I mean, investors like debt-free companies, so to say. So how do you look at this?
Frankly, I'm not in that camp, because if every company is debt-free, then how will the country grow? And if the country doesn't grow, then how will we make money? So someone has to invest. वो बोलेंगे नहीं आपके कंपनी इन्वेस्ट करो हमारी कंपनी में इन्वेस्ट नहीं होना चाहिए तो आई एम ओके आई थिंक द ओनली थिंग विच वी बेसिकली टेक इनटू कंसिडरेशन इज debt to EBITDA should be below 2.5 times and ROC should be 14% minimum. So as long as your ROC is above your weighted average cost of capital plus premium of volatility, because the world is so uncertain, I think the companies will survive and companies will grow.
Hopefully.
So we in fact even invest in metal companies. I have no problem. In fact, last 5 years I've made more money in metal companies than any of the high-tech companies. That has been the thing. So it's fine. It has to be manageable and it has to be justifiable based on the incremental ROC which will make on your investment.
No, I quite like this argument because, if you look at top 1,000 companies in India in terms of market cap, the debt to EBITDA has been just coming down over the last 5 years.
In fact, Navneet mentioned about tax cut. In fact, I know people will hate me, but I don't think that income tax cut from 35 to 25% for companies and taking away all the investment allowance reserve and all was justifiable. Because the companies which benefited the most are the companies which are selling soaps and shampoos and, toothpaste without investing a single paisa in India. They take away royalty, they take away dividends, they don't leave any money here. These companies should be taxed 50%, not 25%.
Okay, so the next question is to Vishal. Vishal, how do you see the role of technology now that everybody is talking about AI? And Navneet mentioned, thankfully, Indian market is not really high on AI right now. But how do you see the role of technology, investor education, and all of that in terms of the business valuation or impact on market value, all of that?
Thanks, Revati. So I was listening to Vijay Kedaara when he was talking in the beginning. And if I just have to summarize in one sentence, the message that he was giving, essentially market valuation And, Manish and Sunil are talking of demand supply here. So market, it sounds like they said demand supply, and what Vijayji said, I can think of it as greed and panic. One of the first lessons I learned in the stock market, yeah, when things are going up, everyone gets greedy. When things are going down, everybody gets panicky, and that kind of drives the market. Now, I'm just thinking, how do I answer your question when we are talking of demand supply and greed and panic? Because it seems like things are being driven more by emotion and by liquidity versus actual, metrics and analysis. But jokes apart, let's come to the question. There, naturally, given the large amount of expansion in investment and the large expansion in the retail base in the stock markets today, in the equity markets today, data needs to be available. People need to make sensible valuations. It can't happen, in the example that Vijayji did earlier, where it's based on tips that we are getting. So naturally, the more information available, the more intelligence that people have access to, the better decisions they can make. Having said that, individuals should probably be careful before they invest large sums of their wealth or their savings or whatever investable capital, I would say. Personal example, I used to be a very, very active investor back in 1995 to 2000 until the dot-com bubble burst. My entire wealth became half in 1 week. Half. Yeah, and I didn't have much that time. So thoda bahut jo tha, wo aadha ho gaya. I never invested directly. It's all mutual funds now, and I've done extremely well. So the analysis is now more in choosing funds and fund managers versus choosing stocks, and it works. But overall, I think the more information available, the more analysis people can do, the better it is naturally. You don't want to make emotional decisions. Those are never the best decisions.
Right. So Manish, you look at different sectors, right? And can you tell us, sectors, outline industries where valuations are mispriced, negatively, positively, against the business value of the company, most often than not?
So Revati, firstly, I'm not a huge player in the markets like Vijayji or all my mutual fund friends here, but I've learned to appreciate the power of the market. So me saying the market has misjudged intrinsic value, who am I to say that? I fundamentally, the power and the humility that one gets even as an investor when you're trying to exit your positions, I don't think it's up to us to say, as I'd outlined earlier, to us, not mechanically, but there are intrinsic values based on certain series of cash flow, the timing and the probability, right? Valuations change a lot based on your perception of your cost of capital. Right? So that's intrinsic and fundamental. All I would say is, and I'm just say how, obviously it seems to everyone, and we talked about it, India being a natural hedge. If Navneet said that, the AI is just unreal. But the reality is, until that actually happens and there will be a correction, who knows there will be or not, it'll still create a whole bunch of winners, right? I'd always said Oracle, the business plan should be, you keep making a public announcement every month of a JV with some other company. As their market cap increases, you take some of your percentage of capital gain and return it. But really, as a private equity investor, what do you worry about? Obviously, if you invest in a very high market, today you can argue consumer space in India is over, but even 15 years ago it was relatively higher, right? Our only issue is once you enter a certain company, we have a limited amount of time to play our game and to increase performance. You can only speak about in EBITDA growth. What is returns compiled of? EBITDA growth and multiple expansion or compression. If you invest in a company where the sector itself compresses your multiple, no matter how much hard work you do in EBITDA growth, as private equity, I don't have the ability to hold on for more than 8, 9, or 10 years. So I am just more careful if it's a very exuberant market. And it's not that you don't invest in companies then. You still invest in it, but your margin for error is almost, your bar is much, much higher. So you say, okay, if I could tolerate this amount of pain, I can tolerate much less uncertainty if I'm paying a higher valuation. And naturally, instead of putting all my eggs in consumer, I'll shift it today. Financials are a little bit more attractive relatively. Tech services is even more, Indian tech services is even more attractive in terms of low multiples. So to me, the issue is not absolute numbers, but relative. Where do you expect multiples to be today versus 5 years later? And no matter how much hard work you do in increasing your EBITDA, if there is a significant multiple compression, no matter what you do, you can't make your returns. So in summary, it's out of pure humility and respect for the market, it's not for us to say, what is higher and lower. It'll depend. There are too many other variances. There are too many. Your own cost of capital is huge. I just think each person has to behave and understand their cost of capital, which is a reflection of risk, and your holding ability. If you have everlasting holding ability, you can buy anything, it'll be cheap.
Okay. So, the last question before I open the floor to everyone is like, what is the change that you would like to see in the Indian capital markets? What is the delta that you would like to see, regulatory or otherwise, in the Indian capital markets?
So frankly, I am of the believer that in a scenario where regulators are there and so many participants are there, we at least bother about things which are in our hand and we adapt to it. So whatever the regulatory environment, whatever the conditions, we are very happy with it. I think to the credit of all the regulators in India, whenever any regulations is introduced, there is always a resistance to it because human beings by nature don't like changes. But I think the fact of the matter is that we now have 20 crore investors, we have a $5 trillion market cap, as Navneet mentioned, so much liquidity, so much participation, so much wealth which has been created. I think by and large, we are doing pretty fine. And things which are doing pretty fine, why do we want to change dramatically what is happening? There will always be some tweaks here and there. I think some might be considered positive, some might not be considered positive, but we'll live with it.
So don't fix something which aren't broken.